Firstly, it was very steady. One of the things this management team has focused on is giving deliberate, predictable results for the marketplace. So we're very pleased with that. But the standouts on the business performance, institutional equities was a total blowout. They had a phenomenal quarter, $1.8 billion in revenues. Best quarter. It's been a business that's been doing great for a long time, but had an absolute blowout. Wealth management margins, 5th quarter in a row, 18.5%. And in fixed income, bringing down the risk-weighted assets, we're below where we were in the first quarter, which was below the year-end target at $239 billion. So there was a lot of good news. Not perfect. This is a continuous journey, but a lot of good news.
Let's talk about equities for 1 second. Blowout is a great word, and it must feel good, but it suggests that it's perhaps not sustainable, is it?
Oh, I think it's very broad-based. If you looked at the equities performance by region and by product, it was very strong. Prime brokerage was very strong. Cash equities was very strong. The derivatives business was strong. It was strong in Asia, strong in Japan, strong in Europe, and strong here. It was a good performance, no question about it.
Any weaknesses?
Oh, sure. There are always weaknesses, unhappily. I mean, our ROE isn't where we want it to be. We're on that journey, but it isn't where we want it to be and need it to be. That's number one.
Is that what's most disappointing?
That wasn't disappointing. That's clearly a function of where we are in this sort of turnaround of the institution. So it was well understood, but it's not where our aspiration is. Our non-comp expenses are up a couple of $100 million. We took some extra reserves relating to litigation, as we have to. There is litigation coming out of the financial crisis that all the banks are now dealing with. Fixed income recovered materially from the second quarter of last year, but isn't where, again, we want our fixed income business to be and will be.
We've covered a lot of ground very quickly there, so let's just take a step back and slow it down for 1 second. Talk about the brokerage business. I have said it before, and many people have said it. This is your singular achievement at Morgan Stanley, building this retail franchise out into something that is larger, more profitable than it has ever been before for this firm. It clearly has some traction. If the third quarter is as good as the second quarter was, can you get the pre-tax margin, which is sort of the hallmark of profitability in that business, up to 20%?
Well, I think I'm less focused on which quarter that happens in, but it will happen. The
problem is investors are focused on which quarter.
Oh, sure.
It happens in.
Investors are impatient. By their nature and design, they want results to exceed always. We laid out some targets a couple of years ago, and we were premature. And I think I said it to you, Erik. We got ahead of ourselves coming into a very long, extended zero interest rate environment with a depressed equities market. The equities market has recovered. We laid out new targets of 15%. We obviously just exceeded those. We laid out targets a couple of months ago that we could get to 20 and ultimately above that, and we will. Whether we'll do it in the next quarter or so, I'm less focused on.
Do you think you could get there by the end of the year? Is that a realistic possibility, if not a probability?
As much as I would like to be drawn into it, I'm not going to.
You learned your lesson the first time
I have.
around.
I'm a little slow, but I get there. We Australians take some time.
It's a competitive business, as you know. There aren't that many big players in the brokerage business, but Merrill Lynch remains a very strong competitor and is putting up, as you would know, having once worked there, some extraordinary numbers. I'm not sure if it's apples to apples. It doesn't really matter. But your 18.5% compares to their almost 28%. What is it that they're doing that you could and should be doing more of?
Well, firstly, it's great news because it's proof positive that doubling up in this space was a smart thing to do. So I always like to see somebody out there who's setting a higher bar as a demonstration of what can be done. Secondly, it's a much more mature business. The whole banking strategy actually originated when I was running the business back in 2000, the retail business. So it's had 13 years. We've had a couple of years. So there's some material differences in where we are in the cycle, but what I like is the slope of the gradient.
Let's talk about the fixed income business for a moment. People do tend to obsess about this when it comes to Morgan Stanley, and there's a reason for it, because on Wall Street, an axiom is that size matters, right? It's almost an article of faith. Bigger is better. And if that's true, and I know you're going to debate me on that in just a moment, Morgan Stanley isn't competitive with its larger rivals, for example, Goldman Sachs, Citigroup, and JP Morgan all had considerably larger numbers. Why isn't bigger better in that business?
Well, a couple of things. Firstly, back to the size matters axiom. Our performance this year, we've outperformed all of the institutions that are larger than us year to date. So just in terms of the aggregate stock price performance. Firstly, size matters to the extent that you need to be at scale. So if you have a global multi-product business, as we do with credit, rates, foreign exchange, securitized credit across the whole spectrum, if you have that business, you need to be at a certain scale to get there. We're at that scale. We're comfortable with that. Beyond that, size doesn't matter. What matters is returns. So you quickly go to what is the minimum size you need to be at to be a global player, multi-product player. And then once you've achieved that, what really matters then is the returns. In other words, the composition of your assets, your risk-weighted assets, the capital you are required to employ to support the business, and the returns on that. So we're very focused on returns.
So if that's the case, which businesses inside FIC are getting capital? Which ones are you focused on, and which ones don't deserve capital right now?
Well, it's not so much don't deserve. Some of them aren't earning their returns yet, which we laid out in the conference we had a couple of, well, I guess it was 4 or 5 weeks ago. And clearly our commodities business struggled in the last 9 months, had a better second quarter than it did first, better first than did fourth quarter. Historically, it's been a tremendous business for Morgan Stanley, but that's been struggling. That's one
and there are some potential regulatory constraints there.
Indeed, there have been some changes under Dodd-Frank, so we're making some improvements and changes to that business. Our corporate credit business and credit business have been doing great. Our securitized credit businesses this first 6 months have done great. So if you look across the spectrum of fixed income businesses, we're not unhappy with where we are. We just aren't delivering all that we can deliver.
If you can't find, I know that there has been some talk for some time now that you would like somebody to come in and help to capitalize that commodities business. If you can't find that investor, that partner, is that a business you still want to stay in?
Well, absolutely. And as any business executive, what you're doing is always looking and remaining open to different structures and different options that can help improve returns. If we could find the right structure to help with our commodities business, we'd move on it. But as you've noted, we've been talking about this for a year. We haven't acted, which is the sense that we're quite patient. We have very strong underlying commodities business. We have no compulsion to act rashly. We're trying to find a structure, if it's out there, that would help us manage a larger balance sheet in that business, has higher cost of funding, requires a lot of liquidity, but is fundamentally a very strong business.
As you acknowledged just a couple of minutes ago, your return on equity isn't where you'd like it to be, hovering around 6%. Do you still feel as good about getting to your target of 10, and presumably more beyond that, as you did when you set it?
Absolutely. No change whatsoever. You can't obsess about 13-week periods because there's too much going on. For example, we had a charge relating to the close of the Smith-Barney transaction. That won't repeat itself. We didn't own 35% of that business, and the earnings from that won't repeat itself. So what you've got to look at, Eric, is what does the future look like, not what is the past. We've laid the bricks very patiently over a 3 or 4 year period, and now we're building on it.
You and I have talked many times about compensation. Is comp street-wide where it needs to be right now?
Well, comp should be a reflection of returns for shareholders. So there's no absolute level. It's in the context of shareholders giving you their equity and getting a decent return on it. As all of the banks are recovering, obviously shareholders are starting to get better returns, and with that compensation will reflect that and reflect market and competitive pressures.
Is everyone behaving rationally, or are there still some bad actors out there?
This is a complicated industry, as your question implies. There are always, I don't want to call them bad actors, there are always irrational behaviors from different firms at different stages of development, different strategies. I don't care about, I don't care about other firms. I don't want to talk about other firms. What I care about...
Well, then talk about the degree of irrationality. How much less rational is it now, say, than when things were most rational? You know, put it on a spectrum.
Oh, I think things are pretty rational right now, to be honest. I mean, I've been in and around the industry for 25 years. It's a sober environment that we operate in. I think the leadership of the banks, all of whom I know pretty well, are very sober, quality, professional people. And I don't see a lot of holes at the large institutions in terms of rational behavior at all.